Welcome to the Three Questions Webcast series. I'm Wayne Baxter with One Capital Management. At One Capital Management, we develop and implement strategies for our clients which strive to grow, protect, and ultimately distribute their wealth. And we do that by offering investment wealth management services. Thank you for taking time to check us out. My clients are often referred to as cross-border clients. Now, why is that? Well, it's because they're either U.S. or Canadian residents who invest in U.S. and or Canadian dollar-denominated securities like stocks, bonds, and ETFs. Our process for advising our clients includes an in-depth discovery and diagnostic analysis of their wealth management goals and objectives. And needless to say, that will include an in-depth review of their investment strategy. Equally important are the regular portfolio reviews that are performed by our portfolio managers once we have determined the appropriate allocation. Now, these reviews occur on a 5-week rotating basis. When constructing and reviewing our clients' portfolios, there are 5 basic principles that we live by. I'm going to go over them with you now. Number 1, it's the portfolio's overall results that matter, not the results of the component parts. The second one, the less correlated the returns of these portfolio components parts are, the better. Number 3, effective diversification means that not all investments will work or fail at the same time. 4, systematic portfolio rebalancing will add to your return while reducing risk because capital market returns tend to revert to the mean. And 5, tax management, this is for taxable accounts of course, tax management adds significantly to after-tax returns. For many clients, we allocate a portion of their portfolio to bonds or bond ETFs, exchange-traded funds. What does a bond offer to a portfolio? Well, for one thing, it adds annual income with a coupon for a set period of time. The principal is returned at maturity, of course. Including the right mix of bonds or bonds ETFs into your portfolio can reduce portfolio volatility, minimize the chances of large losses, provide stability of income, and improve the odds of long-term wealth creation and preservation. But as we've seen recently, owning bonds has risks as well. And we're going to explore some of those risks on this episode of the Three Questions Webcast. On this episode of the webcast, we're going to be reviewing the 3 questions cross-border investors should be asking about their fixed income strategy. And joining me for this episode is Randol Curtis. He's the Deputy Chief Investment Officer here at One Capital Management. Randol's also a member of One Capital Management's Investment Advisory Committee, and he specializes in fixed income investing. In other words, who better to have on today's webcast? Randol, thanks again for making time to join me on the webcast.
You're welcome.
I really appreciate it. We've done a few of these now in different iterations. I was thinking about this yesterday, actually, in preparing for our webcast today, that I think of all the people I've met here in the U.S., you've worked with me on more webinars and seminars than I think anyone else I know. So I really appreciate the time you give me, and I really do find it valuable. I'm a bit of a nerd when it comes to this stuff, and I remember back in Canada, we used to have my former firm. We used to have quarterly due diligence meetings where we would bring the portfolio managers in from all these different companies, and I was always the one who asked all the questions and likely had everybody rolling their eyes going, more questions from Wayne. So really appreciate your time and the chances we get to connect.
It's a pleasure.
It's all good. Before we address our 3 questions today, I'm interested in your observations here of the events that we saw recently where we had California and New York state regulators seize the assets of the Silicon Valley Bank, or SVB as most people know it as, and Signature Bank, respectively, and the turmoil that has resulted as a result of all of this in the banking sector here in the U.S. and now ultimately we had over in Europe as well. Just get your perspective, if you could.
Yeah, well, first of all, it's important to note that these were very specialized banks. And what that means is that their deposit bases came from very concentrated group of depositors. In the case of Silicon Valley Bank, largely centered in the Northern California region, where a lot of venture capitalists and small technology companies had built up deposits in Silicon Valley Bank over the 2-year period starting around the pandemic time. So their deposit base was very heavily concentrated in the venture capital industry and tech companies. In the case of Signature Bank, they had developed a niche in the cryptocurrency world where they had raised a lot of deposits from related to cryptocurrency fundraising. So, the first thing to note is that these aren't your sort of average community or large banks. They were banks that catered to very specialized groups of depositors. And then, that being a unique feature, the more general feature was that in both cases, they were just good old fashioned runs on the bank, essentially, which is that in both cases, Silicon Valley Bank being the sort of higher profile one, investors or depositors sort of got word that there had been withdrawals, and that sort of snowballed to the point where a lot of deposits were requested in a very short period of time. To give you some numbers around that, Silicon Valley Bank had approximately $175 billion of deposits on March 8th, and on March 9th they had $42 billion of withdrawal requests. So you're talking about, almost a quarter of their entire deposit base.
And about another 50 million, another 50 the next day.
Yeah, and so the following day, but by that day it's too late anyway.
FTC said game over,
down.
pretty much,
yeah.
Right?
So banks do keep liquid assets, and they're available to fund withdrawals, and that normally shouldn't be a problem. In the case of Silicon Valley Bank, they hold their assets in two different categories, and one of the categories they're able to mark those assets, those bonds at cost, but not at market value. And the market value of those bonds in the case of Silicon Valley Bank was considerably lower than the price at which they were holding them on the balance sheet, or indicating that they were interest. Now, ultimately those bonds would pay off, but in the short term, to sell them and fund the deposit withdrawals put them in an insolvent position, because they had to realize losses essentially in the interim. So that's what shut them down. Now, the good news is that the Federal Reserve Bank of the U.S. reacted very quickly, and over the weekend on March 10th, this is now 2 weeks ago. It was, the failure was on March 10th. Over the weekend on March 12th, the Federal Reserve Bank in the U.S. issued a bank term funding program that essentially made nationalized and made unlimited insurance for depositors in the U.S. banking system. So they effectively removed risk for all depositors in the U.S. Previously, the Federal Deposit Insurance Corporation really had a sort of nameplate insurance at $250,000 per account to insure depositors. But if you had amounts over that, they would be uninsured. So effectively, the program that the Fed set up ensures that even deposits greater than that will be there will be liquidity made available in case those are withdrawn, essentially, which is effectively insures them. So that was great. What that resulted in is they completely eliminated the systemic risk in the U.S. banking system. Systemic risk being defined as another run on the bank, because no matter how much depositors decide to pull from the banks, essentially the banks can pledge their assets to the Fed, get dollar for dollar funding, and fund those deposit withdrawals. So there's no systemic risk now to the banking system. I think it was a good decision by the Fed, given the likelihood of a domino effect, which we had seen in 07, 08. The likelihood of that recurring, they basically eliminated it. So I think that's great. The good news is depositors are totally protected. The bad news is that the shareholders are not, and the bondholders of banks are not. And, and we've seen regional bank share prices fall quite a lot, let's say approximately 30%. I think that what we could end up seeing in the U.S. banking market, we continue to see some deposit flight from smaller and regional banks. We could see some consolidation in the U.S. banking market. We could see the big banks getting bigger. These are the big money center banks that, name brand banks that you would have heard of, your JP Morgan Chases, Banks of America, Citibanks, Wells Fargo's, and so forth. Your smaller regional and community banks may suffer some deposit flight. The reality is that the they're safe, and we will still have a regional banking system, which is very important to the U.S. economy in terms of community lending and in terms of competitive deposit, making competitive rates on deposits for depositors. But it may be smaller than it was pre SVB and pre Signature. How much smaller? I don't really know. Some amount smaller in terms of assets. The good news is that the banking system is basically held intact, and we're continuing on, and the market, I believe, will begin to look through this, and it kind of already is really. So it's not going to become a systemic failure.
I can't help but think about my understanding, and I definitely will always defer to you on this, Randall, but my understanding to some degree, the Treasury Secretary came out and said basically that they were going to evaluate these, the protecting of assets more on a case by case basis, but the overall spirit is yes, major problems will come like the cavalry in and protect everybody. I can't help but think about the accountability that's going to be required now. There's going to be have to be a lot more supervision and scrutiny over these banks if there's no longer a limit of $250,000 of protection per account, one would think.
Yeah, I mean, I would expect additional regulation as a result of this,
I
or
would too.
what it might actually end up being is it might actually end up being just a reinstatement of some Dodd-Frank banking regulation that was rolled back. There was a lot of very onerous regulation put in place after the 07-08 crisis. Some of that regulation was rolled back a few years ago. They may try to sort of reinstate some of that. My view is if they sort of made permanent the term fund lending program that they just put up, that pretty much fixes the problem. It's just a question of whether or not they're willing to do that. The interesting thing about it is the mere existence of that program sort of precludes its need. In other words, the fact that they say that they're standing available to make those liquidity available for all deposit, for banks to pledge assets and fund deposits, it sort of should reduce the fear and the need for that to even occur. And that's kind of the idea behind the FDIC insurance anyway, except the FDIC insurance is pooled insurance where, the banks pay a premium essentially to the FDIC, which is federally managed insurance program. And then if any one of them fails, they guarantee up to $250,000. What they've done here is they've taken it on the back of the Federal Reserve Bank instead of the FDIC. So more regulations possible. That's
You'd have to think so. I mean,
Yeah.
you really have to think so because, the each individual bank, I guess board of directors or the banks have to decide how they're going to allocate their deposits. And if the deposits are going to be guaranteed 100%, you would say that they're going to have a lot more scrutiny over what their choices are.
Yeah, I mean, as it stands, banks file quarterly call reports with the state banking regulators and the FDIC. So, it's not as though they're not like a private company. I mean, they are, to the extent they're the member of the Federal Reserve System and the FDIC system pool, the regulators are watching their balance sheets continuously. And so that is already in place. In the case of SVB and Signature, those call reports had been filed. They were good. They were approved by the regulator. They were fine. There was nothing really wrong with them. They were compliant with the law. The real issue is that in the case of Signature Bank, is that they held very long dated agency securities and that had decreased quite a bit in price, and that they never expected to have to sell them because they never expected to have such a large number of withdrawals, such a large amount of withdrawals. They had held other money back to fund those potential withdrawals, and they had held an amount that was acceptable to the regulator, but then they got a massive amount of withdrawals in a very short period of time. And sort of that's what caused them to sell bonds that they never expected to sell, that they expected to hold to maturity. And so that was, the real issue there. We'll see if the regulator comes in and mandates a more balanced matching between the assets, even if they are held to maturity, and the liabilities of the bank, which are the deposits for the bank. That may happen too. They may begin to limit the net interest rate sensitivity or the net exposures that the banks are taking on more than they have in the past.
We've seen the impact that duration, it's become a topic now that people are actually paying attention to, that duration risk can have on a bond if you need to liquidate it before they mature. The way bonds typically work is if you hold it to maturity, you get the principal back. I can't help but think about this. Preparing my notes for our webcast, I was thinking about where we were back in 2020, 2021. Interest rates around the world were, virtually 0.25%, very low. And our One Capital's investment committee, obviously at that point we're searching for yield. And I guess you would say that the search for yield stretched from at one end of this extreme credit risk, at the other end duration risk. Going back and looking at that, maybe just recalling at that time, how concerned were you that we could have the level of volatility that we saw last year? Thinking back now, was it something that was really, did you believe that we could possibly see if I look at our own playbook, we show bonds last year were down like aggregate, of course, across the board. On average, are down like 13%. Was this something that, going back then, that you saw as a potential occurring?
Well, yeah, just to quickly review, for our investors, who may not be familiar with bond lingo, bonds, when yields go up, bond prices fall. That's how it works. And the reason that works like that is because $100 in 5 years is worth less than $100 today. Now, how much less is it worth? Well, the higher the interest rate, the less that it's worth, the bigger the differential. So as the yields go up, the value of future payments, which is the principal that comes back to you in the bond, that goes down, and the market's not willing to pay you as much today for that promise in the future. And the duration risk really depends on how far out that repayment is. The further out the repayment, the more sensitive it is to a change in yields. So if yields go up by 1%, a 1-year bond is not nearly as adversely affected as a 30-year bond. A 30-year bond is really adversely affected from a 1% rise in rates. A 1% rise in rates for a 1-year repayment is not that big of a deal. So that's the idea behind the duration. And when we looked back post-pandemic, we were really in an unprecedented time. We had essentially a zero Fed funds rate, and we had 10-year US bonds trading around 0.5%. That's as low as they've ever been. Part of the reason for that is that because the economy shut down and the Federal Reserve and the Treasury pumped so much money in the system,
Trillions of dollars,
trillions of dollars, including buying bonds themselves, they were artificially subsidizing the bond market to have very, very low rates, essentially to keep the economy from sinking. Because if businesses are closed and economies are closed, how are they going to make payments, right? So the rates were pushed way, way down. And we were very aware that the Fed was subsidizing the cost of money, i.e. making it much, much cheaper than the market supply and demand would otherwise dictate. That is why, one of the things we did was shorten duration in our bond portfolios quite a lot, i.e. meaning that we bought bonds which were repaying more, sooner than, let's say, the average maturities in the market. That reduced our interest rate sensitivity. Could we have predicted the volatility? Well, I can just say that when you start at zero, there's only one way to go, and that's up. So we suspected that there was a very strong likelihood that rates would go up. Now, how high would they go? I can't tell you. I can't claim credit for telling you how high they would go. Quite honestly, if we were to have discussed a 5% Fed funds rate and a 3.5% 10-year US bond at that time, I might have been a little skeptical. I probably would have guessed that we would have gotten up to maybe a 3.5% Fed funds rate, and maybe a 3.5 or 4% 10-year. So I would say we've gone further than we probably would have guessed at the time, but I think directionally we were correct. That's one of the reasons why we had such good relative performance. We were down, but not nearly as much as the broad market indexes. And we took specific targeted actions to create that effect, which was to reduce that interest rate sensitivity in our bond portfolios. The one thing that I would say that we maybe underestimated, which probably everybody underestimated, was just the degree to which inflation would take off. And that is why the central banks have raised rates so much, and even more than what we would have expected. Is just because the inflation has become so persistent coming out of the in the post-pandemic period.
Yeah. So again, the key thing to understand here with with duration, just the example I think we could give is that if you had a 20-year bond and interest rates rose 2% from say 3% to 5%, and the bond price would actually could fall like significantly, like somewhere over 20%. So it is a real risk there for owning long duration bonds. It was one of the things that we looked at when we review with clients that are holding, money in their pension accounts, so and then they just randomly pick a bond fund, right? We would analyze the duration risk of that bond, not as, that to us is as relevant as what's the interest they're getting paid, right? So you want to be mindful of duration.
Yes, and it's not, and just to be clear on the two types of risk, you'll still get paid back the money in 20 years. So
right. If
what
you
we
hold
call
it
the
that
default
long,
risk hasn't gone up at all. That's the credit risk component, what we call the credit or the default risk, which is the likelihood that they just don't pay you back. That may not have changed whatsoever, but the net present value, i.e. the present value of those payments in the future, could drop very significantly. That's the interest rate risk that you mentioned.
And that's what we saw, and quite frankly, that's what we saw to some degree. What happened with the two banks that we're referring to?
Yeah, exactly what happened.
Silicon Valley Bank and Signature, and then we had some fun over in with Credit Suisse and UBS as well afterwards. Let's get right to our three questions. So, as you know, we Randol, obviously being on the committee, we manage clients' money in both Canada and the U.S. One Capital does, and so we're taking this from basically a cross-border perspective. So the three questions cross-border investors should ask about their fixed income strategy. So I am going to pose to you, Randol, three questions. The first one, which is a question that I've been asked more than once here in the last little while, is why would I bother investing in bonds when I can purchase a CD that pays me 5%? Why would I bother that? Why would I even bother investing in bonds that are giving me all these headaches?
We get this question a lot. Usually once investors, work with us on a program, the benefits become crystal clear. There are three main reasons. The first reason is safety. When you buy a CD, there is FDIC insurance that would generally apply up to that $250,000 limit. But in the absence of what we've just seen, which is an extreme emergency measure from the Fed, and the fact that banks have to pledge their assets to get funds to provide the liquidity back to the depositor, we own, you would only be insured in a CD up to the $250,000 limit per account per bank. So in the case of what we, how we run bond portfolios, we diversify across many different bonds. And what that does, and those bonds are of equal or higher quality than the bank itself quite often. So number one, they're as safe as the deposit from a default risk standpoint. But number two, the portfolio as a whole is safer because we've diversified those exposures across borrowers, essentially. So the bond portfolios that we run generally have a more diversified credit risk or less default risk in aggregate. And it's hard for people to believe because when they buy a CD, they just have an account, it shows, and the amount doesn't change. But the reality is that the default risk is actually less in the bond portfolios that we invest in typically. So safety is number one. The second reason, which is a big one, is liquidity. Typically, to get the higher rates that you need on a CD, you have to lock your money up. And it could be 3, 6, 9, 12, 14 months, depending on the CD. And you have no access to it. With our portfolios, you have access every day. And we can, the bond market is very large. It trades in very large amounts. It's very liquid. And the bond portfolios that we manage have very low transaction costs. So, typically, if an investor calls up and needs access to their money for an unforeseen expense or an obligation or circumstances change or something like that, if they had their money in a CD and something changes 10 months down the line, they still might not be able to get it out for another 4 or 5 months. But with us, they can. And you can get out partial amounts too. Whereas a CD, you'd be completely locked up. So we have the benefit of liquidity. The other nice thing that does for us is, and for our clients, is when they have a balanced portfolio and they have both equities and bonds, it also gives us a source of funding to rebalance the equity side, which means
It's so
that,
important.
I'm sorry.
I say it's so important.
Yeah, and that's so important. It's one of the key tenets of our firm in terms of a wealth management business, and it really adds value to the long-term returns and plan and the achievement of that plan for our clients, which is, if we have equity, if we have stock markets drop significantly, we can rebalance account to the target asset allocation by taking some from the bonds and reallocating that percentage to the equities. And what you'll notice is, in the long run, that will generate a positive return for the client. So in a balanced portfolio, having a bond component will enable the rebalancing to take place because we have that liquidity. Whereas in a CD, you just can't do it. You wouldn't be able to reduce your CD a little bit and reallocate that to the target allocation on the stock side of the balanced portfolio. So that's another advantage in addition to just having it available
And it becomes
the,
really important in an environment where, like last year, where the markets were down, like what, over the capital markets, not necessarily our portfolios, but capital markets are down like 17%. So if you're in a 60-40, 40-60 portfolio, it would be, if you want to have success as an investor, you're going to want to be able to have access to that capital, because this is going to be a definite green light for buying equities in that environment.
Yeah, it's a tremendous value added to have it available, and it's almost impossible to predict when that's going to occur. So, you can lock up your money in a CD for 14 months, but I can't tell you whether we're going to have a rebalancing opportunity in 2, 4, 8, or 12 months. It's very, very difficult to tell. So the only way to do that is, it's impossible to tell. So the only way to do that is to be ready with a liquid portfolio that's properly managed and balanced so that we can take advantage of it when it occurs. Okay, so that's, those are and then the third reason is the yield. The yield on the bond portfolios we can get is very comparable to that which you're going to get in a CD. So you've got essentially better safety, better liquidity, and the yield. Now, we can play with that a little bit. Generally speaking, to get higher yields than we're going to get in CDs, we generally include some elements of higher yielding bonds, but usually in a portfolio construct, it's relatively little added risk for an attractive and additional amount of yield. So, we're very competitive in our bond portfolios. To give you an example, right now, our bond portfolios are yielding about 6%, which is sort of better than you're going to get pretty much in any lock CD, but we have total liquidity and very good safety.
I could actually, one of those moments where I can actually add to your points here, Andrew, and Randall, sorry, is for people in the U.S. that have taxable accounts, there's the fourth benefit will be taxes, because a lot of our clients that have money in their trust portfolios, we can actually invest in municipal bonds, and the interest earned on those bonds, they pay zero taxes on. So
we're continuously monitoring that, and we continuously monitor the trade-off between taxable bonds, which would be corporate bonds, U.S. government bonds, which are federally taxable but exempt from state tax, whatever the resident of the account holder's residence is in terms of if they're in the U.S. Sure. And higher yielding bonds, those are all taxable, versus the municipal bond market, which is generally exempt from federal and state taxes, depending on where they live. The state, we almost always get the federal tax exemption, and so we monitor all the break-even yields to see which is most advantageous. And we run very significant municipal bond portfolios and models for clients because of that reason. Generally speaking, the ones that benefit the most are the ones that live in the higher tax states, California's, the New Yorks, and so forth, that generally tend to benefit more from the muni portfolios. But anybody in a high marginal tax bracket federally will also benefit.
Okay, so great answer to the first question, very comprehensive as usual. Second question we have, again, these are the three questions cross-border investors should be asking about their fixed income portfolio. Number two, now that interest rates have risen, are longer duration bonds a safer investment? In other words, has the risk passed? Is it like the storm is passed, all clear here on the Western Front, and we can go out and start buying, 20-year bonds again?
Well, longer duration bonds are safer now than they were, but I wouldn't really characterize them as being safe or not safe. I would characterize them as being a better, they're better than they were. And the reason why I say better is it's a question of how much return you get versus how much risk you take. When rates were at zero on the short end and at 50 basis points on the 10-year US bond, the risk reward was very bad because you're only getting 0.5% interest. Lock that in for 10 years, and you take 10-year duration risk. I mean, it didn't make any sense. You get almost nothing, and you take quite a lot of risk. Okay, now you can go buy a 10-year at 340 and lock that in for the next 10 years. That's a lot more attractive than it was. Now, if the 10-year yield goes up to 5 or 6%, well, you're still going to lose more money on a mark-to-market basis. The default risk isn't going to go up. You'll still get paid back in 10 years, but the current value of that bond is going to go down more than a shorter duration bond. Our portfolios are currently matched to about a 4-year duration. So we're not taking extensive risk. Generally, we manage between 3 and 6. So we're kind of, somewhat toward the middle. I'd say between 2.5 and 6 has kind of been our range. So, and we have been extending duration. The advantage of going to a longer duration bond now is that you lock in that yield for a longer period of time, meaning that if the rates go down, you've got a higher yield locked in and you're earning that higher yield for a longer period of time. The way that the market works is that if the yields go down, you'll actually see capital gain in your longer dated bonds in the short term.
Exactly. The price will go up, actually.
The price will actually go up. And so, yes, on a risk reward basis, longer duration bonds are more attractive now than they were 2 years ago. They are a more attractive, meaning you get much more return, more yield given the risk you take. We're still not willing to go out very long dated. The aggregate bond markets in the US, depending on what index you look at, is more like a 7 or 8 year. And we're not willing to go out there. And the reason being is that inflation has been very persistent, and there is a chance that rates could go up further. And if that happens, we don't want to take, the bonds that we manage are really designed to be the bedrock of the portfolio, the foundation, the baseline, the source of funding for rebalancing. And so we manage with an eye to that, as opposed to trying to match the index or something like that. So, it is possible that if rates go down, that we'll underperform a little bit on the bond market indexes, but that's the price to pay for having, a really solid foundation of value in the bonds in the portfolio.
And at the same time, you're still getting a yield of around 6%. So
it's still a great yield.
It isn't a lose-lose situation.
Right.
Yeah. Okay. Thanks, Randall. For our third question, and I guess this one would speak to the folks when they hear all about this duration talk. They go, their question probably would be something along the lines of, are there alternative strategies that do not include duration? And I guess you could add that provide an attractive yield.
Yes, there most certainly are. And what comes to mind foremost are floating rate bonds and floating rate loans. And those are bonds that have an interest rate that adjusts, usually every quarter. That's typical, sometimes every half year. And because those rates adjust based on an index, their prices do not fluctuate very much at all when yields go up or down. Their interest rate payments fluctuate. In other words, if yields go up, they pay a higher yield. But the price of the bonds doesn't fall because the cash flows are not a fixed set of cash flows in the future. They're adjustable rate interest payments. So floating rate bonds, those are typically seen in private lending markets. Lots of loans that banks make are typically floating rate. Also, there are floating rate corporate bonds, and and bank loans. So all of those have essentially very minimal interest rate risk. They have credit risk, which means there is a likelihood or a possibility that the borrower doesn't repay or doesn't repay fully. We monitor that very closely, but that's the case with every bond that we own. So you get rid of the interest rate risk with floating rate loans and bonds. You don't get rid of the credit risk. The credit risk is still there. We still have to do the work on that. The other thing is that usually higher yielding bonds tend to have pretty short durations. So they do have some interest rate risk, but they are, but it's not as much as, let's say, the broad bond market.
So I guess the question I would ask is, in the examples that you provided, is there any liquidity constraints? Like, we talked about a CD. Sometimes you're locking up for, 3, 6, 9, 10, 12, 15, so on. Yeah. So is there some liquidity restrictions?
So there are in some cases and not in others. In the case of floating rate bank loans, floating rate corporate bonds, floating higher yielding bonds, higher yielding corporate bonds, there are essentially no liquidity constraints. I mean, we can trade those in very large size with very low transaction costs, very tight spreads, and not at all. In the case of private credit, yes, there is. And in the case of private credit, typically for the private credit investments that we look at, we have quarterly liquidity, which is typical for us. And those are pools of loans that we've invested in where, we can redeem, but typically the underlying assets, which are the loans, they're not as actively traded. They are quite often very large and diversified pools, but the liquidity isn't today. It's usually at the quarter end or something like that.
Right.
Yeah.
So again, that speaks back to portfolio diversification. You wouldn't want to have an entire portfolio made up of those types of investments. You may want to have a slice, maybe 5.
Yeah. So for example, we would never go more than, let's say, 10%, in the less
10% of the bond portfolio, or 10%?
Yeah, 10%. Well, 10%. It depends on a balanced portfolio. But let's just say, for example, right now in our fixed income portfolios, we have 5% allocated to private credit. So in a 60-40 portfolio where you have 60 equity and 40 bonds, we've got 5% of that 40%, which is 2% of the entire portfolio, would be in that less liquid tranche. Now that can provide very attractive yields. Right now it's, we're getting 10% yields on that, but it's only for 2% of the portfolio, and that's the quarterly liquidity. Even if we doubled it, it would be 4% of a total 60-40 portfolio. So yeah, we would never get it. We would never increase that very much, because one of the main tenets of our strategy is to provide liquidity to our clients at all time. But for a little slice that's very unlikely to be taken out immediately, to have that little extra yield and only need to wait, typically less than 12 weeks, and you typically 6 to 8 weeks to get a redemption, that's a reasonable trade-off.
You wouldn't want to have 50-60% of your money tied up.
Yeah, we would never do that.
Would not work.
I mean, that's the same idea as going into a CD, right?
Right. I mean, exactly.
Locks your money up.
Right. There's some basic in basically trying to decide, well, how do I have my money allocated? There's some basic call to action, we'll call, for lack of a better word. There's some basic rules of thumb that I have followed. And the first one is, if you want to determine how your money ought to be allocated, the first thing you should do is a cash flow analysis, like what your spending requirements are. And then from there, you create what's called a capital forecast. And that capital forecast can then help determine the spending rates or the growth rates of your portfolio and what your portfolio needs to yield. That's number one. So starting out, the old saying I've said many times, those who fail to plan to fail. So step one, do some forecasting, do some analysis. The second rule is that your stock and bond portfolio can be allocated according to that determination. So in other words, how hard does your money have to work? Let's say you are just entering retirement and you're in your early 60s. We have to assume longevity. you say, well, I don't want to have a spending rate of more than say 2.5% a year, at least for the first 10 years of my life, of my retired life. Well, that can help us determine how your money ought to be allocated between equities and bond. Or if you're later in retirement, maybe you're in your mid 70s, you say, well, you know what, I can have a spending rate of maybe 3.5 to 4.5%, and maybe we could afford a little bit more exposure to fixed income. The third one, and I think this is so important when it comes to investing, is have a plan that we talked about here, and then stick to it. A lot of times people look at what's happening in the news, with the economy, and they wonder, should we change our strategy? And as a general rule of thumb, if we've done all of our planning in the first place, the only reason someone should change the asset allocation of their portfolio is if their circumstances change of employment, change from employment to unemployed or to retiring. Your situation should determine the allocation, not the day-to-day ups and downs of the market. I guess I would just throw it back to you, Randol. If you have any final comments you want to throw in on top of that, or any final thoughts you might have in general, happy if you have any insights you want to share with me, either on the bond market itself or just randomly on investing. I'm happy to hear what you have to say.
Well, we think it's a great time to be invested both in stocks and bonds. I'll say that first of all. The yields are a lot higher than they were 2 years ago. Stock prices are generally lower. And even if we go into a period of slower economic growth, I think that if you look back in 3 to 5 years, you'll find that this was a great time to be working on and investing in a portfolio. So for anyone who's sort of thinking about hiring us and getting going with both the planning process and then subsequently the appropriate investment process, it's a great time in my view. And that's just purely from an investment, perspective. We don't have a crystal ball, but I can tell you historically in times like this, when you look back, it's a good time. The other thing I'll say is that the doomsayers and the large media, outlets, the news channels and so forth, that essentially get rewarded by creating overly emotional reactions. I think that what you said is very wise in terms of tempering reactions to those things, and quite often not even watching them is the best thing, especially for people who hand off their portfolios.
Our clients, not our PMT.
I mean, yeah, oh yeah. I mean, we're on top of it all the time, but that's what we do for a living.
Right.
It's almost better for the clients to do the planning process up front and consult with their advisor and determine what their needs and their plans are, and to hand it off to us. And then for us to methodically and systematically implement that process over a long period of time. And we just get, we get very good results doing that. So, for those of you who feel like that might be a good fit, we're standing here ready to do it. And it's a proven process that works very well. And I think, we stay on top of it in terms of the specific asset classes and the different investment choices. We do quite a good job of that here on the investment committee. And I think that hopefully the discussion we've had today illustrates some of the things we look at least on the fixed income side.
I think you did a great job today, Randol, as always. Once again, I really appreciate you making time for me out of your busy day. Thanks again for taking part today. Randol Curtis is the Deputy Chief Investment Officer at One Capital Management. And I hope that we'll be having him back one time again, not in the not too distant future, to talk more about fixed income investing.
Good. Thank you, Wayne.
I look forward to bringing you the 3 Questions webcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube channel. And to receive notification of when our latest videos have been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and see you soon.